the impact on property if interest rates move down? Doesn't that affect prime a bit more than secondary? You guys worried?
Yeah, I mean, to sort of jump in on the whole prime thing, yes, it would affect prices a lot, clearly. But this whole discussion about prime versus secondary, I think one needs to be very clear here that I don't think there are investors who are buying prime. I think there are people who are not interested in making money, but they're interested in preserving capital, parking money. So they're not really investors. They're just wealth preservationists who are buying that prime stuff. And you're right, if you're buying prime at 4%, and even if you're only putting 40% debt on it, you're in negative gearing territory today. So you're losing money as you go along. Now, I've never been a prime buyer of real estate, so I'm speaking from my own prejudice here, but it strikes me as fundamentally an illogical investment. And it does have costs associated with it. There will be renovations that will occur. That 15-year lease in 7 years will only be down to 7 years. And if interest rates rise, it's going to be a real problem. And eventually, of course, they will rise. But on coming back to the economic projections, I mean, frankly, I think that Collier's projection on, building through with some recovery is being overly optimistic here. I think that this is the new normal. Things are going to be flat for a very prolonged period of time, which probably means flat interest rates, as a matter of fact. I mean, 5 years, 7 years the real question is whether or not we're headed into a Japan-type syndrome. So although the risk of rising interest rates will screw things up very badly with prime, I think the risk of that actually happening is quite slow. I think the greater thing that everyone needs to sort of adjust their minds to is that a very flat, virtual non-growth economic situation is the new normal for the foreseeable future. So adjust to it.
I think that I'd agree with that. I mean, I think interest gilt rates have been kept low through quantitative easing at some time. That will end and rates will go up. And although the margin between real estate and gilts is at a fairly historic high, you could make an argument that it's better to price it against credit default swaps for governments rather than gilts itself. But I think I also agree that interest rates are likely to stay low. And I think one consequence of that is that we can't have the so-called creative destruction of sort of companies that are just not viable economically coming to the end of their life. So a number of things will just continue with these so-called sort of zombie companies, which makes it harder for the economy to turn itself around.
Yeah, I mean, with low interest rates, I mean, one of the things that's clearly been true, you talk about all the corporate money that corporations are sitting on, is that there are a lot of companies, and frankly a lot of real estate funds and REITs and others that have, not just in this country but in Europe, that have been kept artificially alive by virtue of the low interest rates. And therefore the natural Darwinian clearing process that should have been going on for the last 2-3 years has not been happening.
I don't want to sound too much like Boris Johnson, but we are optimistic at Collier's, and there are reasons for that, actually. If you look at yields for London and you look at rental growth, I think we do see, for the right assets, rental growth, and I think that will help performance. What we're finding in London is that clearly from an occupational point of view, I think everyone's quite right, that it's not just the yield, it's actually the tenant demand and the rental growth. What we're seeing in London, obviously we're involved on the Place, which is the sister building to the Shard, just on the south of the river, one of the best buildings in London, is that I think the rental growth for prime assets, particularly in the West End, will go up. The reason for that, there's a shortage. When Mark put his slide up to say that in Mayfair, there's, on the net absorption figure, I think it's 200,000 square feet of new space coming onto the market. That is a very small amount of space. It's almost the size of this building in context of the Mayfair market. So I think what we can see is that rental growth will help your initial returns in London. But you're absolutely right, it's wealth protection and preservation. If you have your money in the bank, I don't think you'll get probably more than 1% returns on your asset, and if you can get rental growth, that helps. I think the other thing I'd say from Collier's point of view is that across Europe at the moment, you are having probably two types of investor. You are having the prime, the person looking for prime best property, and then you're having the return, I think, of the sort of more entrepreneurial, not necessarily North American, but the actual sort of the higher risk curve investor, mainly because it's a ripple effect. If you can't buy a building in central London because they are too expensive, you then have to start looking at the regions, or you have to looking at different use classes, and I think that's beginning to happen. Because I think real estate is still seen as a particularly attractive, balanced part of a balanced portfolio.
I think that's a very important point because it's the income in a low interest rate environment that investors are looking for. So it's easy to be depressed about the state of the economy. I think we probably all agree that the meteoric rise in the short term is extremely unlikely. Mark sort of set the tone by talking about a risk of structural depression, cheered us all up right at the beginning. So I think that's quite a challenge, but certainly our investors, and this is really looking globally for sources of capital for Europe, there is a sense that property is providing something that you can't get through the fixed income markets. Provided you have well-let property, it does deliver a decent income return, and investors on the whole are holding their nerve and they're more inclined to put more money in than to take it out at the moment. So I think there is a positive there. I think the challenge, of course, is where do you then put the money? How much work is involved in actually getting investors to make a commitment? And I think if you look at some of the statistics on capital raising, it's taking about twice as long now to achieve the first closing on a new fund as it used to in what we might regard as a normal market. But I think the idea that normal is the kind of boom times that we were enjoying in the early 2000s, I think that's unrealistic. And in a way, it's a surprise that we haven't seen other Japan-type scenarios. And if you're going to speculate on where the next one might be, I think Europe is unfortunately quite a good place to look. So I think this is the new reality. Property has a place in that.
Just on the income position, I suppose we can go up and down here in terms of our sentiment. Looking at the lease events in our database on the UK, some staggering statistics have come out of that, in that the kind of most depressive statistics effectively the last 10 years, and that 60% of all leases aren't renewed at expiry. So that's one of the kind of pressure points we're picking up, that 50% of all break options are exercised. The fact that kind of market rents are trending 10% below actual paid rent, so that people are wanting to break their leases, and that 65% of the leases that went up for expiry last year still remain unlet. So there are clear challenges there in the occupier market, and income is the lifeblood of the asset class. And so that in the UK market, which is relatively healthy when you compare it with the rest of Europe, it does have its own challenges, and so that kind of picks out pockets of depressed performance within the UK as well.
Just going back to your point in terms of the interrelationship of interest rates and capital values, if interest rates did go up, then it would impact presumably on capital values of real estate, but it would impact on all the other asset classes as well, and probably have a disproportionate effect on fixed income investors. And I think I've certainly seen the view expressed that there may actually be an increase in allocation by institutions to real estate because of concerns about the capital volatility of fixed income investments and the fact that we're moving into a new market cycle in terms of return from equities.